Hi. Let's learn about Basel III, what it is, capital requirements, and implementation. Basel III is an international regulatory accord that was introduced to mitigate risk within the international banking sector. This agreement requires banks to maintain certain leverage ratios and keep certain levels of reserve capital on hand. It was begun in 2009 and is still being implemented as of 2022. Basel III was developed by the Basel Committee on Banking Supervision, a consortium of central banks from 28 countries, shortly after the financial crisis of 2007 to 2008. The new rules were initially supposed to be implemented by 2015, but the deadline has been pushed back and currently stands at January 1, 2023. Basel III is part of an ongoing effort to enhance the international banking regulatory framework that began in 1975. Basel III sets a minimum total capital ratio that a bank must maintain at 8% of its risk-weighted assets, with a minimum Tier 1 capital ratio of 6%. The rest can be Tier 2. Unlike Basel II, Basel III increased the portion of capital that must be in the form of Tier 1 assets and eliminated Tier 3 from the calculation. Basel III requires banks to maintain additional reserves known as countercyclical capital buffers, ranging from 0% to 2.5% of a bank's RWAs. These buffers provide extra capital during periods of economic contraction. When considering both the minimum capital and buffer requirements, a bank could be required to maintain reserves of up to 10.5%. Basel III introduced new leverage and liquidity requirements to guard against excessive and risky lending. It set a minimum leverage ratio for banks and established several rules related to liquidity, including the liquidity coverage ratio and the net stable funding ratio. The goal of Basel III is to improve regulation, supervision, and risk management within the worldwide banking sector, addressing the inadequacies of Basel I and Basel II that became clear during the financial crisis of 2007 to 2008. Here are 3 key takeaways. 1. Basel III is an international regulatory accord that introduced a set of reforms designed to improve the regulation, supervision, and risk management of the banking sector. 2. Basel III is an iterative step in the ongoing effort to enhance the banking regulatory framework. 3. A consortium of central banks from 28 countries devised Basel III in 2009, largely in response to the financial crisis of 2007 to 2008 and ensuing economic recession. As of 2022, it is still in the process of implementation. Hope this would help. Thanks for watching.